Right now, across the American landscape, the restaurant industry is quietly bleeding.
It really is, yeah.
Like foot traffic is down, margins are compressing, and major fast food chains are frantically hiking menu prices. We're talking like 15, 20, sometimes 25%, just to mask the fact that fewer people are walking through their doors.
It's essentially a race to the bottom, right? Yeah. And it's entirely funded by the consumer.
Exactly. But then you look at the Q1 2026 earnings transcript for CAVA Group. They just posted a 32.2% jump in revenue.
Which is just staggering.
Right. And not by gouging their customers, but by pulling off the exact opposite strategy.
Yeah.
I mean, they are holding the line on prices, and their foot traffic is exploding.
It is arguably one of the most counterintuitive financial realities in the retail sector today.
Absolutely.
You have an economic environment where discretionary spending is supposedly paralyzed, yet this Mediterranean fast casual concept is posting numbers that look like a software company in a boom cycle.
And that is exactly what we are tearing into today. Welcome to our deep dive.
Glad to be here.
Whether you are holding the stock, eyeing an entry point, or just, fascinated by the mechanics of a company breaking all the traditional rules of retail expansion, we are going to extract the real story from KVA's first quarter earnings call.
There is a lot to unpack.
There really is. We want to answer one fundamental question. Is this a self-funding, compounding machine with a bulletproof unit economic model, or is it like a momentum trade propped up by hype?
Yeah, that's the multi-billion-dollar question.
So we're going to dig into the headline numbers, the hidden pricing psychology, management's hyper-conservative guidance, and the underlying technology infrastructure making it all possible.
The place to start, undoubtedly, is the architectural difference between how CAVA is generating its revenue versus the rest of the industry.
Right, because the headline number, that $434.4 million in Q1 revenue, is loud.
It's very loud. But the composition of that revenue is what dictates the long-term viability of the business.
So let's break that composition down. Same restaurant sales, or SRS, were up 9.7%. For anyone tracking retail, near double-digit same-store sales growth is elite territory. But the mechanism behind it is what really caught my eye.
Because in the restaurant business, you really only have two levers to pull to increase that number.
Exactly. You can increase the ticket size, meaning you just charge more for the same food, or you can increase traffic, meaning more actual humans walk through the door.
Which brings us to the defining metric of this entire earnings call.
Yeah.
Of that 9.7% growth, 6.8% was driven purely by traffic.
Wow.
More people are showing up, and they are showing up more frequently.
I mean, compare that to the macro environment. You look at the legacy burger and chicken chains, and they are reporting flat or negative traffic.
Right, they're losing customers.
Their quarterly earnings might show like a 4% revenue increase, but when you read the fine print, their traffic dropped by 3%.
Yeah.
They just forced a 7% price increase on a captive audience to make the math work.
Yeah, and CVA is doing this organically. It's a critical distinction because price-driven growth has a very hard ceiling. Eventually, the consumer just breaks.
They tap out.
Right. A customer will tolerate a price hike on a burger once, maybe twice, but the moment that fast food combo meal crosses the psychological threshold of, say, $12 or $14...
But the value proposition just shatters.
It shatters completely. They stop coming. Traffic-driven growth, however, implies market share acquisition. CAVA is physically taking customers away from competitors.
And you can see that flowing to the profitability, right? Their adjusted EBITDA came in at $61.7 million.
Yeah, which is a 37.6% increase over Q1 of 2025.
That kind of leverage only happens when your fixed costs are being absorbed by higher and higher volumes of foot traffic.
Spot on.
Okay, so the revenue and the EBITDA are screaming growth. But look, I'm looking at the bottom line of the income statement in this transcript right now.
Ah, the EPS?
Yeah, diluted earnings per share, EPS, came in at 20 cents. And that is an actual drop from the 22 cents they reported in Q1 of 2025.
Yeah, and net income was down too.
Right. Net income was $23.6 million, down from $25.7 million. So, I mean, if I'm scanning a financial terminal and I see revenue up 32%, but earnings going backward, my immediate assumption is that the cost structure is out of control.
Sure, that makes sense.
Are they spending too much to acquire these customers? Like, what gives?
It is incredibly common to see that exact reaction in the market, which is why, we have to separate GAAP accounting realities from core operational realities.
Okay, break that down.
GAAP generally accepted accounting principles requires companies to record certain non-cash items that can severely distort the actual health of the business.
Okay.
The drop in EPS here has zero to do with the cost of chicken or labor or real estate. It is a pure accounting anomaly related to corporate taxation and equity-based compensation.
I need you to translate that into plain English for us. How does employee stock cause net income to drop when revenue is surging?
All right, let's look at the mechanics of restricted stock units, or RSUs. When a public company grants stock to its employees, the value of that stock is locked in at the grant date.
Okay, makes sense.
But the employee doesn't actually own it until the stock vests, which is usually years later. And the U.S. tax code has a specific provision here.
What's the provision?
If the stock price goes up significantly between the grant date and the vest date, the company gets to claim a tax deduction on that newly created value.
Oh, I see. Because they are technically compensating the employee with an asset that is now worth a lot more money.
Precisely. So in the first quarter of 2025, CAVA experienced a massive surge in their stock price right as a large tranche of employee equity vested.
Okay.
This triggered an enormous one-time tax benefit. That tax benefit flowed straight to the bottom line, artificially inflating their net income and their EPS for that specific quarter.
Wow, okay.
It made Q1 2025 look exponentially more profitable on paper than the actual sale of Mediterranean bowls would suggest.
So it's basically a phantom baseline. Q1 2026 isn't a weak quarter at all. It's just being compared to a quarter that was heavily medicated by a one-time tax windfall.
You nailed it. The cleanest way to see the truth is to just look at pre-tax earnings.
What do those look like?
If you strip away the tax line item completely and just look at the money generated from operations, CIVA's pre-tax earnings surged by nearly 50% year over year.
That is massive.
Yeah, they generated almost $25 million more in actual operational profit.
And what about cash taxes? Are they actually writing massive checks to the IRS right now?
Barely anything immaterial. They are still sitting on a mountain of net operating losses, or NOLs.
Remind us how those work again.
So when a company operates at a loss during its early expansion years, which CAVA definitely did to build out its national footprint, the IRS allows them to carry those losses forward.
To offset future taxable income, right?
Exactly. They are essentially cashing in historical loss coupons, meaning their actual cash outlay for taxes remains incredibly low today.
So the EPS drop is literally an illusion created by the tax code, not a reflection of a deteriorating business model.
That's a perfect way to put it, yeah.
That reframes the entire earnings report for me. I mean, the top line strength is real, the traffic is real, and the profit margin on the food itself is expanding, not contracting.
And that's what really matters.
Which brings us to the operational strategy driving this. How are they pulling off 6.8% traffic growth in an environment where consumers are objectively strapped for cash?
The answer to that lies in extreme pricing discipline. In the transcript, CEO Brett Shulman details their approach to inflation.
What did he say?
In January of this year, they took a price increase of just 1.4%. And more importantly, they held the base price of their bowls and pitas completely flat.
A 1.4% increase. I mean, that's practically margin of error.
It really is.
I was at a regional grocery chain last week, and a standard box of cereal was up 15% from last year. Fast food drive-thrusts are routinely running 8 to 10% higher year over year.
Yeah, and Shulman actually put this into historical context on the call, which is vital for understanding their long-term moat.
Okay, let's hear it.
Since the end of 2019, so before the pandemic and the subsequent inflationary crisis, GDA's cumulative price adjustments represent only slightly more than half of the cumulative consumer price index.
Wait, really? So they are deliberately absorbing a portion of the inflation themselves.
That's exactly what they're doing.
Instead of passing 100% of the rising cost of olive oil, packaging, and labor onto the consumer to protect a quarterly margin percentage, they are just taking the hit.
They are playing an infinite game while their competitors are playing a finite one. By eating some of those costs, they are creating this massive chasm in perceived value between themselves and the rest of the industry.
And we're seeing this play out in the demographic data, right? Specifically regarding the K-shaped economy.
Yes, this was a huge part of the Q&A.
During that Q&A, an analyst probed about the health of the consumer, and Shulman brought up this exact concept. For anyone listening who is unfamiliar, a K-shaped economy refers to a divergent economic reality.
Right, where different groups experience completely different recoveries.
Exactly. The top arm of the K represents upper income households. Their home equity is up, their stock portfolios are thriving, their wages outpaced inflation. They are totally fine.
They're doing great.
But the bottom arm of the K represents lower and middle income households. Their wages stagnated, their rents skyrocketed, their pandemic savings are completely gone, and inflation is just consuming a massive percentage of their take-home pay.
And traditional retail logic dictates that in a K-shaped economy, a premium fast casual brand like CAVA should see severe attrition in that bottom cohort.
Right. A consumer on a tight budget should theoretically abandon the $13 Mediterranean bowl and trade down to a $7 fast food combo meal. Or just, eat rice and beans at home.
But the transcript reveals the exact opposite.
This blew my mind.
Management explicitly stated that their lower-income cohorts are their strongest performing demographic segment right now.
The people with the least amount of discretionary income are actually increasing their visits to CAVA.
Yeah, because value is not synonymous with cheap. Value is a ratio, right? It's the quality of the experience divided by the price paid.
That makes a lot of sense.
Fast food chains have spent the last 4 years aggressively degrading their own value ratio. They shrank the portion sizes, they automated the hospitality out of existence, they reduced the quality of the ingredients.
And simultaneously raised the price to $10 or $12.
Exactly. And the lower income consumer is looking at that proposition and feeling completely alienated.
Oh, for sure. The cognitive dissonance of paying $12 for a sad, flattened burger handed to you through a window by someone who won't even make eye contact is profound.
It's insulting to the consumer, really.
So true.
When that consumer has a limited budget and wants to allocate funds for a meal out, which is, by the way, a psychological necessity for morale, the classic lipstick effect or treat culture, they want a guaranteed positive experience.
Right. And Shulman defines KAVA's value proposition through 4 pillars, didn't he?
He did. Ingredient quality, the health relevance of the Mediterranean diet, physical convenience, and warm hospitality.
So the lower-income consumer recognizes that spending $13 at KAVA yields a massive bowl of fresh greens, braised lamb, feta, and complex marinades in a vibrant environment.
The return on investment for their scarce dollars is exponentially higher there.
It's basically the outsourced cook dynamic. KVA's internal surveys show they score incredibly high in the difficulty of recreating the food at home.
Oh, absolutely.
I mean, if I buy a fast food burger, I know I could grill a decent one in my backyard for $2. But the barrier to entry for cooking Mediterranean food at home is enormous.
Think about the supply chain and prep time required. To replicate a standard CAVA order at home, you would need to source high-quality tahini, pomegranate molasses, harissa.
Make crazy feta from scratch.
Right. Pickle your own onions, slow braise meats. The ingredient cost for a single household to build that pantry is prohibitive, let alone the hours of labor.
So CAVA is doing the heavy lifting at scale, which provides this undeniable utility to the consumer regardless of their income bracket.
Exactly.
Which naturally leads us to the menu engineering discussed in the quarter. Because they aren't just relying on their legacy items, they are actively manipulating the menu to drive this frequency.
Yeah, they executed 2 major moves in Q1. First, they brought back the roasted white sweet potato.
And they didn't just position it as a side dish, right? They categorized it as a complementary main.
The strategic value of the sweet potato is twofold. From a consumer psychology standpoint, it provides a hearty, satiating, plant-based option that hits the comfort food craving while remaining under the halo of health.
And from a financial standpoint,
root vegetables carry spectacular gross margins. It really balances the plate costs when paired with more expensive proteins.
But the massive news on the food front was the launch of their first ever national seafood offering, the pomegranate glazed salmon.
Yes. They are marinating it in pomegranate date molasses, harissa, red wine vinegar, and bold spices. It aligns perfectly with the omega-3, B12, heart-healthy ethos of the Mediterranean diet.
But the financial mechanics behind this salmon, as explained by CFO Trishan Tolivar, are absolutely vital to understand.
Tolivar noted that they priced the salmon to be penny profit neutral.
Let's stop right there. This is a concept that often trips up novice investors who are hyper-focused on margin percentages. So let's run the actual math on penny profit neutral so there is no ambiguity.
Okay, sure. Let's assume a standard grilled chicken bowl sells for $11.
Got it.
The raw ingredients for that bowl, the chicken, the greens, the grains, the sauces, let's say they cost CAVA $3.
Okay, so that leaves $8 of raw gross profit. The margin percentage is roughly 73%.
Right. Now, salmon is a vastly more expensive commodity to source, transport, and hold than chicken. Let's say the raw ingredients for the salmon bowl cost $6 instead of $3.
Oh,
If CAVA wanted to maintain that exact same 73% margin, they would have to charge a customer upwards of $22 for the salmon bowl.
which would instantly destroy the value proposition we just spent 10 minutes analyzing.
Correct. The consumer would reject it. So instead, CAVA prices the salmon bowl at $14.
Okay, let's do the math. The ingredients cost $6, which leaves exactly $8 of raw gross profit.
Exactly. The absolute dollar amount flowing into the cash register is identical to the chicken bowl. The penny profit is neutral.
But mathematically, the margin percentage on that salmon bowl has plummeted from 73% down to roughly 57%.
And that is why Talivar explicitly warned analysts on the call that the salmon rollout is expected to be an approximate 100 basis point headwind.
Wait, a full 1% hit?
Yes, a 1% hit to their overall margin rate for the balance of the year.
So a surface level analyst sees a 100 basis point margin contraction and just downgrades the stock, assuming the company is losing its pricing power.
But sophisticated investors realize you don't take percentages to the bank to make payroll, you take dollars to the bank.
That's a great point.
If a customer who normally visits CAVA once a month for a chicken bowl is so enticed by the premium salmon that they start visiting 3 times a month, CAVA is collecting $24 in absolute gross profit from that customer instead of $8.
Wow.
The margin percentage on a spreadsheet looks worse, but the actual cash generated by the business is multiplying.
It is a totally calculated trade-off. They are sacrificing a vanity metric margin percentage to drive immense frequency, capture market share, and stack absolute cash dollars.
And they are treating the rollout with intense operational rigor, too. They aren't even guaranteeing it will be on the menu forever.
What do you mean?
They stated it will run through the fourth quarter at minimum, treating it as a stage gate process.
To ensure their supply chain and line workers can handle cooking a delicate protein at scale without bottlenecking the stores.
Right. Operational discipline is really the through line of this entire transcript, which makes their forward-looking guidance so fascinating.
Yeah, let's pivot to that, because management possesses all this momentum, traffic is surging, the salmon is a hit, the lower-income consumer is loyal, yet their projections for the rest of the year are incredibly restrained.
Yeah, let's dissect the guidance because there is a glaring anomaly here.
So management raised their full-year outlook. They expect 75 to 77 net new restaurant openings. They increased adjusted EBITDA guidance to between $181 million and $191 million.
Okay.
And they bumped full-year same restaurant sales guidance to a range of 4.5% to 6.5%.
Now, on its face, raising guidance in the first quarter is a flex. It signals to the market that the internal models are tracking ahead of schedule.
But look at the math on that same restaurant sales number. Q1 came in at 9.7%.
Right.
During the Q&A, an analyst actually pressed Trisha Talivar on current trends, and she stated on the record that Q2 is currently tracking in line with Q1.
Which means the second quarter is also humming along near 9 or 10% growth.
Exactly. So the mathematical implication of that is stark.
Very.
If the first half of the year averages near 10%, and your full year guidance is a midpoint of 5.5%, you are actively telling the market that the second half of the year is going to flatline.
You're basically modeling for 1 or 2% growth, maybe even 0 in Q3 and Q4.
I look at that and wonder, do they see a catastrophic consumer recession looming on the horizon, or is this like the most aggressive sandbagging operation in modern retail history?
Honestly, it is less about terror and more about extreme, calculated prudence.
How so?
Talivar addressed this directly. She stated the updated outlook contemplates a more moderate, mid-single-digit comp assumption for the balance of the year. We really have to look at the macroeconomic environment management is operating within.
The broader landscape is highly volatile right now.
Extremely volatile. And public company executive teams are heavily penalized by institutional investors if they overpromise and underdeliver. Missing a guidance target destroys credibility for years.
So they are padding the stats.
Well, Chimier's management is looking at the horizon and seeing persistent geopolitical conflicts, particularly in the Middle East, which threaten global shipping lanes.
Yeah.
They are looking at an election year in the U.S., which historically causes consumer spending to pause due to uncertainty. And critically, they are modeling for severe energy fluctuations.
Yeah, they specifically called out energy costs as a margin headwind in the transcript. They projected a 20 to 40 basis point hit purely from elevated fuel and energy costs.
The restaurant industry is deeply tethered to the price of a barrel of oil. It's not just the cost of electricity to keep the lights on and the grills hot.
What else is it?
If fuel prices spike in the third and fourth quarters, supply chain partners immediately institute fuel surcharges to deliver the lettuce and the chicken. Furthermore, oil prices dictate the cost of raw materials for packaging.
Ah, the polyethylene bowls.
Exactly. The physical plastic bowls, the lids, the utensils. A spike in crude oil directly compresses the gross margin of a single CAVA bowl sold in suburban Chicago.
So rather than projecting a rosy scenario where inflation miraculously vanishes, management is actively baking these worst-case scenarios into their guidance.
Which is smart. If the headwinds don't materialize, they blow past the 5.5% target and look like heroes. If the headwinds do hit, they meet expectations and protect the stock price.
Classic under-promise, over-deliver. It's textbook.
Yeah.
But what I find even more compelling is that despite modeling for these headwinds, they are not slashing investments to protect short-term margins.
Yeah, they are doing the opposite.
They're pouring money into labor and technology. Let's look at the Flavor Your Future platform they discussed. They're rolling out a brand new Assistant General Manager, or AGM, positioned to over 50% of their highest volume locations.
This is a masterclass in long-term capital allocation. When a restaurant concept is trying to scale from 300 locations to 1,000 locations, the limiting factor is rarely capital, and it is rarely real estate.
It's human capital. It's finding people who actually know how to run the building.
Precisely. Operating a CVA doing $3 million in annual volume is incredibly complex. You are managing dozens of employees, a complex fresh food supply chain, digital orders, walk-in orders, and third-party delivery drivers.
A general manager in that environment faces massive burnout risk.
So introducing the AGM role serves a critical dual mandate.
The first being sheer operational integrity during peak hours. When you have an 80-person line wrapping around the building at noon on a Tuesday, having a secondary leader on the floor means the line moves fast, the food doesn't run out, and the hospitality doesn't degrade into chaos.
But the secondary mandate is pipeline development. The AGM role is essentially an incubator.
Oh, that makes sense.
Shulman highlighted a team member named Adriana Cervantes on the call. She started as a guest experience manager, graduated into the AGM role, became a general manager, and is now working toward becoming an academy manager to train the next wave of leaders.
By institutionalizing this AGM role, they're creating a bench of trained, battle-tested managers. When KBA signs a lease for store number 400 next year, they don't have to hire a stranger off the street and hope they can learn the culture.
No, they just tap an AGM who has been running a multi-million-dollar box for 18 months.
And they noted that this represents roughly a 2% investment in team member wages. But because their top-line revenue is growing so fast, that 2% investment is completely absorbed.
Their overall labor costs remained flat year over year as a percentage of revenue. They are funding their own future management pipeline out of current operational leverage.
That's incredible. And they're arming those managers with serious technology. Shulman spent a significant portion of his prepared remarks detailing the rollout of KavaCore and KavaCurrent. He called it the precipice of a decade of data transformation.
Which sounds like corporate hyperbole until you actually understand the underlying architecture.
Walk us through it.
KavaCore is their modern data foundation, centralizing all the data inputs across the enterprise. But KavaCurrent is the really fascinating piece. It is an edge-enabled operating platform.
Now, edge computing is a term usually reserved for cloud infrastructure companies, not fast casual Mediterranean food. Break down how an edge-enabled platform actually changes the day-to-day operations of a restaurant.
In traditional legacy restaurant tech, the point-of-sale system, the cash register, and the kitchen display screens are entirely dependent on a centralized cloud server.
Usually hosted in an AWS or Azure data center hundreds of miles away, right?
Right, so every time a customer places an order on the app or a cashier rings up a bowl, that data has to travel to the cloud, be processed, and travel back to the store.
Which introduces latency. And if the internet connection drops, the store effectively ceases to function. They can't process payments or route tickets to the kitchen.
Edge computing moves the processing power to the edge of the network, meaning physically inside the four walls of the restaurant. KavaCurrent allows the local systems to process massive volumes of transactions instantly, without waiting for the centralized cloud.
So when a store is attempting to process hundreds of digital and physical orders in a single lunch hour, eliminating 2 seconds of latency per transaction equates to processing 10 more customers an hour.
It's a massive throughput multiplier, but it's not just about speed, it's about predictive intelligence.
Tell me more about that.
The ultimate goal of integrating KavaCore and KavaCurrent is predictive scheduling and predictive prep. Managing a fresh food supply chain is a nightmare of variables.
Oh, I can imagine.
If you prep too much chicken, it spoils and your food costs spike. If you prep too little, you run out during the dinner rush, alienate customers, and lose revenue.
So the system will eventually use machine learning to ingest real-time APIs. It can look at historical sales data, factor in local weather patterns, knowing that heavy rain increases delivery mix, but suppresses walk-in traffic check local event schedules, and dynamically tell the kitchen manager exactly how many pounds of falafel to drop in the fryer at 11:30 a.m.
Yes. It removes the guesswork. It lowers the cognitive load on the management team.
That is wild.
Instead of an AGM spending 45 minutes in the back office trying to build a spreadsheet prep schedule for Tuesday, the system just automates it.
And then the AGM can spend that 45 minutes on the floor, training the staff and engaging with guests. Technology is being utilized to amplify human hospitality, not replace it with a kiosk.
Exactly. And they need that throughput because the digital channels are massive for them right now.
How massive?
Nearly 40% of their total sales are now digital. That's up from roughly 36% in prior years.
A 40% digital mix fundamentally alters the unit economics of a physical store. I mean, it means almost half of your revenue is being generated without a customer taking up physical space in the dining room or standing in the physical line.
They specifically highlighted growth in third-party delivery channels, too.
Now, historically, third-party delivery is a total margin killer for restaurants. Uber Eats and DoorDash take massive commissions, sometimes 20 to 30% of the ticket.
It's a huge cut.
And the transcript shows that CAVA's other operating expenses line item actually went up by 80 basis points to 13.3% of revenue, heavily driven by these increased delivery commission fees.
But again, look at their pricing discipline here. Management confirmed that they have priced their digital and delivery menus at a premium to offset those exact commission fees.
So the delivery customer pays a higher price for the convenience of having it brought to their door.
Right. Which means the transaction remains profit neutral on a dollar basis to CAVA.
They aren't subsidizing the delivery apps. They are passing the cost to the consumer who values the convenience while protecting the absolute profitability of the transaction.
It's brilliant. They are capturing the volume without surrendering the margin.
It is a highly sophisticated omni-channel strategy. They are meeting the consumer exactly where they want to be met, whether that is a physical line, a digital pickup shelf, or a third-party driver, and ensuring the financial return to the company is identical across all mediums.
Which perfectly tees up the final synthesis, I think.
Yeah, we've gone deep into the headline revenue, the tax anomalies, the pricing philosophy, the margin trade-offs of the menu, and the hyper-prudent guidance. It is time to look at the bedrock of the entire enterprise. Let's examine the balance sheet and the actual unit economics to reach a final verdict.
The balance sheet is arguably the most compelling piece of this entire transcript. CAVA ended the first quarter with $403 million in cash and short-term investments.
That's a huge pile of cash. And the debt load?
Zero. Absolutely zero debt on the balance sheet.
Incredible.
They also have a $150 million revolving credit facility sitting completely untouched, giving them access to $500 million in liquidity at a moment's notice.
In the current macroeconomic reality, where the Federal Reserve has held interest rates at 2-decade highs, having zero debt is an insurmountable competitive advantage.
It really is. Other fast casual competitors who loaded up on floating rate debt during the zero interest rate era of 2020 are now just suffocating.
A massive percentage of their operating profit is being vaporized just to service the interest payments on their debt. They literally can't afford to open new stores.
But CAVA, meanwhile, is generating cash. They produced $64.1 million in cash flow from operations in Q1 alone and generated $15.5 million in pure free cash flow.
During the Q&A, Johnny Zonko from JP Morgan floated an interesting idea. He asked management if, given this massive war chest of cash, they might consider acquiring real estate directly or engaging in asset deals to accelerate their growth even faster, rather than just signing traditional leases.
And Trisha Talivar's response was a masterclass in capital discipline. She acknowledged that they evaluate all options, but unequivocally stated that the highest and best use of their capital right now is simply building more organic CAVA restaurants.
Because why complicate the model when the core engine is running this hot?
Exactly. When you look at the unit economics of a single CAVA restaurant, the return on invested capital is staggering. Their system-wide average unit volumes, or AUVs, have reached $3 million.
We really need to contextualize $3 million for the retail investor listening. A typical, highly successful national fast food franchise with a drive-through might do $1.5 million to $1.8 million a year.
Right, that's standard.
Hitting $3 million out of a 2,500 square foot inline retail space without a drive-through is rarefied air. It puts them in the operational vicinity of a Shake Shack or a Chipotle.
But the metric that truly secures the bullish thesis is the performance of their newest cohorts.
Let's talk about that.
When a restaurant chain expands rapidly, there is a natural fear of cannibalization or diminishing returns. The assumption is that you open your best locations first, and as you expand into secondary or tertiary markets, the revenue per store drops.
But Talvar shattered that assumption on the call. She noted that the new 2026 cohort of restaurants is tracking at over 100% productivity.
Which is phenomenal. Historically, a new restaurant experiences a honeymoon curve. They open, there is massive local hype, sales spike, and then after a few months, the novelty wears off and sales drop 15 to 20% to find a stabilized baseline.
But Cavia's new stores are opening in extraordinary volumes, matching or exceeding the record-breaking 2024 and 2025 cohorts, and they are staying there.
They're instantly operating at that $3 million annualized run rate. And this isn't just in coastal, high-income enclaves. They mentioned successful recent openings in the Midwest.
Like Cincinnati, Columbus, St. Louis, Chicago.
Yes. The Mediterranean flavor profile is proving to have genuine mass market appeal across geographic and demographic lines.
So if we distill all of this data into an actionable verdict for you, the retail investor analyzing this stock, the evidence points overwhelmingly to a highly robust, self-funding compounding model.
They're generating a 25.1% restaurant-level profit margin, a margin they maintained completely flat year over year despite inflation, the rollout of salmon, and a 2% increase in labor investments.
They take that 25% profit, pool the cash, and deploy it to build 75 new stores this year, which will instantly start generating their own $3 million in revenue and 25% margins, generating more cash to build more stores.
It's a perfect loop. They're bypassing the debt markets and equity dilution entirely.
It is the platonic ideal of retail expansion. They are ignoring the frantic promotional discounting wars consuming the rest of the industry and relying on operational execution, pricing integrity, and technological infrastructure to steadily steal market share.
For anyone evaluating the portfolio, the verdict is clear. This isn't a trendy momentum stock reacting to a hype cycle. The underlying architecture is pristine.
They have zero debt. They are shielding the consumer from the worst of inflation to build generational brand loyalty. And their cash-on-cash returns for new real estate are phenomenal.
The structural integrity of the business, to borrow an earlier thought, is sound.
But before we wrap up this deep dive, there is one final forward-looking element buried in the transcript that demands attention.
Oh, yes. This is the big one.
We've spent an hour dissecting the walk-in customer, the digital pickup, and the third-party delivery mix. But management is quietly laying the groundwork for a massive secondary revenue channel that the market is arguably barely pricing into the stock's current valuation.
The catering program.
Yep. During the call, Brett Shulman provided a subtle update on their catering rollout. They are not rushing this. They are currently running a highly controlled capacity management test in the Houston market, with plans to expand it to a second market later this year.
The restraint is intentional. Catering is notoriously dangerous for a fast casual operator.
Why is it dangerous?
Well, if a store receives a $1,500 corporate catering order for noon on a Wednesday, it can completely hijack the kitchen.
I see.
The staff gets overwhelmed building 40 custom bowls for an office park, which means the regular customer walking in off the street suddenly has to wait 20 minutes in line. The walk-in customer has a terrible experience and never comes back.
You risk destroying your core business to change incremental catering dollars. But Kiosilia's solution to this is brilliant. They aren't just telling their existing stores to figure it out. They are utilizing purpose-built real estate.
Right. They highlighted that they currently have over 20 locations equipped with hybrid kitchens or designated digital kitchens.
These are essentially centralized production hubs. They have expanded prep areas, secondary make lines, and dedicated walk-in coolers specifically designed to handle massive catering volumes without ever interacting with the frontline operations of the standard restaurant.
They are building the plumbing before they turn on the water. They are solving the load balancing equation in Houston right now, ensuring that when they finally launch catering nationally, the logistics are flawless.
And the financial implications are profound. Catering orders represent massive ticket sizes, incredible labor efficiency. I mean, making 40 identical bowls requires vastly less labor per bowl than making 40 customized walk-in orders, and it's entirely incremental revenue. So as you review your thesis on CAVA Group, we leave you with this final thought to ponder. This company is already generating an elite $3 million in average unit volume strictly off individual consumer orders.
Right.
What happens to their top-line revenue and their bottom-line cash flow when they finally perfect this centralized production model, flip the switch, and unleash a high-margin national catering program across 400, 500, or 800 stores?
The flow through to the bottom line could fundamentally re-rate the earning power of the entire enterprise.
And that is why we read the transcripts.
Yeah.
When you just look at the surface, a seemingly expensive stock with an EPS drop on a screener, the picture looks distorted. But when you dive deep into the unit economics, the pricing psychology, and the strategic patience of the management team, the true trajectory becomes crystal clear.
Absolutely.
Thank you for joining us on this deep dive. Keep looking past the headlines, stay focused on the fundamentals, and we will see you next time.